A balance sheet is one of three key financial statements a publicly traded company must put out. I gave you a high-level overview of all financial statements in this video discussing Apple's 10K. In this video, I will discuss how to analyze a company's balance sheet and key financial ratios involving the balance sheet, which will help you gauge its liquidity. If you want to invest in individual stocks, conducting a thorough analysis of a company's financials is essential. Hi there. If you're new here, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. The balance sheet has three main components: assets, liabilities, and equity, or stockholders' equity. And the balancing equation is assets is equal to liabilities plus equity, or assets minus liabilities equal equity. Apple's balance sheet doesn't list all the different components I wanted to discuss. So in this video, we will look at the balance sheet of Alphabet, Google's parent. Again, this is not a recommendation to buy or sell Alphabet. The video is for education and entertainment only. Go to google.com, click on About, and search for Investor Relations using Ctrl F. Click on Investor Relations to take you to Alphabet's SEC filings. All these 10 Qs are Alphabet's quarterly reports. We are looking for the annual report, which is the 10K. You can always look at quarterly reports, but the annual report has more comprehensive information. So I will show you the 10K instead of the 10Q. Also, the annual report is audited and the quarterly report is unaudited. An audited report is more likely to be free from material error or fraud than an unaudited one. Page 47 of the 10K shows you the consolidated balance sheet. The first section under assets is current assets. These assets consist of cash or any asset the company can sell, consume, or convert into cash within a year or one operating cycle. Marketable securities, including time deposits, bonds, stocks, mortgage-backed securities, etc. These are liquid securities. You can find information about marketable securities in the notes to consolidated financial statements. Banks and financial institutions tend to hold more marketable securities than other industries. The next one is accounts receivable. Includes any amount due in exchange for goods or services already delivered. Google generates revenue mainly through advertising and selling products such as Fitbit, Nest Home products, and Pixel devices. There can be a gap between when products or services are delivered to the customers and customers pay cash. Companies also keep an allowance for losses on accounts receivable. For example, in a market downturn, smaller companies may go out of business and may be unable to pay for goods or services of Google. A sudden increase in receivables may indicate relaxed credit relationships with customers, but could also signal the company's inability to receive timely payment for delivering goods or services. Inventory, the next item, includes any physical finished products ready to be sold to customers such as Fitbits, Nest products, and any raw materials used to manufacture those products such as chips, casings, wires, etc. A sudden increase in inventory may indicate that the company is preparing for an uptick in orders shortly. On the flip side, it may also suggest that the company doesn't have sufficient demand for its finished goods, causing a buildup in inventory. To derive better conclusions, you must analyze financial statements holistically. You cannot look at one data point or just one financial statement. Other current assets typically include expenses paid in advance, but they are not significant enough to warrant a separate line item. For example, a company may pay its insurance premium once a year, for the entire year. Insurance premiums are recorded as an asset on the balance sheet on the day they are paid, and the company must record 1/12 of this premium on its income statement as an expense and reduce that amount from the balance sheet every month. Next, let's look at current liabilities. The company owes these amounts within 12 months after the balance sheet date. Accounts payable are amounts the company owes its vendors for goods and services. Accounts payable is the opposite of accounts receivable. For example, Google may buy chips for its Pixel phones on credit. The company adds the amount it owes its vendors to accounts payable. A sudden increase in accounts payable may indicate the inability of a company to make timely payments. It could also mean improved credit relationships with vendors. Accrued compensation and benefits include employee benefits that are accrued but not paid out. For example, if you get your salary monthly, your company accrues your salary over the month as accrued compensation. Then, once it's paid to you, the company records it as an expense on the income statement and reduces the accrued compensation on the balance sheet by the same amount. Accrued expenses and other current liabilities include costs such as current portion of operating leases and other long-term debt. For example, if a company owes a loan with a maturity of 10 years, accrued expenses will include the current portion of that loan, which is the sum of all payments due over the following 12 months. The long-term portion of this debt will be included in the long-term liabilities. The next item is accrued revenue share. You may not see this item for all companies. Accrued revenue share differs from accrued revenue, which appears as an asset on the balance sheet. Alphabet pays its partners a small percentage of revenues. For example, YouTubers may get a small portion of YouTube advertising fees. Until Alphabet pays out this share to its partners, it may record that portion as part of accrued revenue share. Deferred revenue, on the other hand, is when the company receives payment but it is yet to deliver the product or service. Think of Netflix. Netflix charges a monthly subscription fee at the beginning of the month. Netflix has already collected the revenue, so the service it needs to deliver is recorded as a liability because Netflix owes it to its subscribers. So to record a deferred revenue equal to the monthly subscription at the beginning of the month, and at the end of the month, Netflix will have delivered the service and the deferred revenue will be reduced on the balance sheet and recorded as revenue on the income statement. This forms the basis for accrual-based accounting instead of cash-based accounting, which I will discuss at some point. You can also think of airlines. Airline companies sell tickets in advance. Until the flight is due, payment from ticket sales is deferred revenue. When you subtract current liabilities from current assets, you get the company's working capital. While a healthy balance sheet should indicate sufficient working capital, excessive working capital may suggest issues with management of assets and liabilities. Before discussing non-current assets and liabilities, let's look at some ratios we can calculate using current assets and liabilities. The first is the current ratio, which measures a company's liquidity. It is the ratio of current assets to current liabilities and indicates the ability of a company to meet its current liabilities. The current ratio of Alphabet is 2.38, which is healthy. You want the current ratio to be greater than 1. But more importantly, look at ratios over time instead of just point-in-time data. This chart shows the current ratio over the past 10 years. The current ratio has decreased recently, meaning either the current assets have declined, liabilities have increased, or both, or the growth in liabilities has outpaced the growth in assets. However, It is above the median current ratio for its peer group. Let's look at Starbucks on the other hand. Not only is the current ratio below 1, it is also below the median current ratio of its peer group, suggesting liquidity problems. Another ratio to measure liquidity is the quick ratio, which is similar to current ratio but stricter. It doesn't include inventory or other current assets in the numerator. Only cash, marketable securities, and receivables. A third ratio is the cash ratio, which is the ratio of cash plus marketable securities to current liabilities. Both these ratios are well over 1 for Alphabet, which indicates that Alphabet has more than enough liquidity to fulfill its current obligations. It is important not to base investment decisions on one measure only. Analyze financial statements holistically and over time. This video has gotten longer than I had initially planned, and I wanted to cover non-current sections of the balance sheet, but we will look at that in the following video. If you found this video valuable, please share it forward and like this video and subscribe to my channel if you haven't already. Your support keeps me motivated to create great educational content for you. And let me know in the comments if you want me to talk about anything specific. As always, don't forget to be happy, to be kind, and to be your best self. I'll see you in the following video. Bye.